Okay, let's unpack this. I mean, imagine taking the world's most volatile asset, right, and using it as the foundational collateral for the global economy.
Yeah, it sounds like a recipe for disaster.
Because that is exactly what is happening right now. Back in October 2025, Bitcoin peaked at an all-time high of like $126,199. But today, we're sitting in a really gut-wrenching 46% free fall.
Right, it is a massive, massive drop.
So to figure out why, our mission for this custom deep dive is to decode a highly sensitive April 2026 institutional strategy memo. We want to see how massive capital is navigating this crash and why this cycle fundamentally changes how digital assets are traded forever.
And the chart certainly looks terrifying for you as an observer.
Yeah.
But the underlying mechanics of what Bitcoin actually is, well, they have fundamentally matured. I mean, it is no longer just a speculative retail token.
Right.
It has actively transitioned into regulated collateral. Just look at the state of New Hampshire.
Oh, yeah, the bond thing.
Exactly. They recently issued the first Moody's-rated B2 municipal bond backed entirely by Bitcoin.
Which is wild. I mean, it is like taking a volatile tech startup and suddenly using it as the steel foundation for a skyscraper.
That's a great way to put it.
But, wiring the building's fire alarms directly to the foundation's self-destruct button, an emergency on the top floor brings the whole building down.
Yeah.
Because if it is so structurally sound and regulated now, I have to push back here.
Sure.
Why are we in a 46% free fall? The memo notes whales have dumped 188,000 BTC over the last year. If this is a strong foundation, why is the building shaking so violently?
Well, if we connect this to the bigger picture, the shaking isn't coming from the crypto market itself. We're looking at a massive macroeconomic contagion.
Meaning external factors.
Right. This crash is heavily driven by the Middle East conflict, specifically Operation Epic Fury, and Donald Trump's April 6th ultimatum.
And just to be super clear with you listening, we are impartially reporting the memo's details here. We aren't taking any political sides on Epic Fury or the administration's policies. We're just tracking the market impact. But that ultimatum, it demanded Iran reopen the Strait of Hormuz, right?
Yes, exactly.
Wait, so you were saying a geopolitical standoff over oil directly forced a massive crypto sell-off?
It did.
Because here is where it gets really interesting. The memo shows Brent crude oil spiked to $120. And because we live in this hyper-financialized world, that spike triggered a massive liquidation of tokenized oil on a decentralized exchange.
Over $17.17 million worth, to be exact.
Wow.
And the crucial mechanism here is cross-margined accounts. You see, traders on these platforms, they pool all their collateral together.
Right, they don't separate their risk.
Exactly.
Right.
So when they got margin called on those tokenized oil shorts, the automated protocol simply didn't care what else they held in their portfolios.
The algorithms just force-sold their Bitcoin to cover the oil losses. The gears of these two completely different markets are now tied together.
Which resulted in an instant $9,000 flash crash in Bitcoin.
That is insane.
Yeah, it wiped out 94,058 traders over a single weekend. And not because Bitcoin failed, but because oil spiked and the code executed without hesitation.
And that instant flash crash, I mean, it completely changed the institutional playbook.
Yeah.
The memo details how algorithms are engaging in this thing called wick hunting.
Yes, wick hunting is when automated trading bots are programmed to spot exactly where retail traders place their traditional stop losses.
Oh, wow. So they literally target them.
Right. The algorithms intentionally drive the price down just enough to trigger those stop losses, forcing retail to sell and then instantly scoop up the cheap assets. That is why institutions are abandoning standard stop losses entirely.
So what does this all mean for you as the listener? If standard stop losses just make you a target and institutions are staring at an 8.4 million BTC supply and loss overhang.
Which is basically a massive ceiling of underwater traders waiting to sell at break even.
Exactly. They aren't just going to blindly buy into that resistance, right? How are they playing this?
Well, they are defensively scaling in. Instead of buying all at once, they are placing laddered limit orders.
Meaning a staggered series of automatic buy orders at lower and lower prices.
Yes, catching the falling knife safely.
Yeah.
They are trailing these orders down to the ultimate cyclical baseline.
The 200-week simple moving average.
Right, which is sitting at $59,000. Institutional money isn't panicking. They're using options to hedge their downside risk and just waiting.
Just letting it ride.
Yeah, they're letting this chaotic macro environment flesh out all the over-leveraged retail traders before they step in fully.
And this highlights exactly why you need to understand these automated cross-asset mechanics. If you don't see the gears turning behind the screen, you just become liquidity for those institutional whales.
Absolutely. You have to know how the machine operates.
Right.
You certainly can't look at one asset in isolation anymore. I mean, tokenization means everything is inherently connected now.
Which leaves us with a pretty terrifying but a fascinating thought to leave you with. As more real-world assets like oil and real estate become fully tokenized and cross-margined, well, will the next global financial meltdown be caused not by central banks or policy failures, but by automated code reacting to a geopolitical shock at 2 a.m. on a Sunday?
It really makes you wonder.
If we are building skyscrapers on this new digital foundation, we better make sure the algorithms know how to handle an earthquake.